Well, I'm catching up with Paul Miron of a company called M Squared Capital. They're in the credit space at a time when interest rates are on the rise. So he's the right person to talk to. Great to see you, mate.
Thank you so much.
A lot of people out there are really worried about interest rate rises, fed by my mates in the media, and probably they've been fed by some economists who I think have gone to la-la land with their forecasts. What is your expectation about what interest rates might happen for the rest of 2022 and maybe rolling into early 2023?
Look, the forecasts in relation to inflation it all stems down from inflation.
Yep.
So if we can get inflation under control to the parameters where Reserve Bank is comfortable, then there's no need to increase interest rates to up to 3.6%, and that's what the financial markets are factoring into.
Is that within 2022 or within a year of when
those forecasts are within 12 months.
Yeah.
So to increase interest rate, the official cash rate to 3.6, you have to go really hard.
From point one to 3.6.
That's right.
We have to have ballistic inflation of like 1970s capacity where it got to about 18% or something.
Yeah, and the issue is that you can't really compare the Australian market to the US, for example. Yeah. Their inflation is a significant or much bigger problem as well. You've got wage inflation cutting through as well. Yeah. They had the second inflation figure coming out, which was only 0.2% difference between what they had on the previous quarter.
Yeah, slight fall.
That's right. Yeah. And the increase of money supply that they've had as a proportion to what we've done in Australia is significantly higher as well. I think I read somewhere that 42% of the entire money supply had been increased during COVID period. So that's extreme.
I know when I interviewed Michael Knox from Morgans, he made the point that when a US budget deficit blows out to that proportion, history kind of says that the dollar falls, but the US dollar is not falling at the moment, probably for a number of other reasons. Yeah. Okay, so it's your game to understand where interest rates are going, because ultimately people come to you, you offer higher interest rates than bank deposits because you're not as safe as bank deposits, as most things aren't. But where do you think interest rates are going? Because that's going to be important to not only borrowers in the future, also your business.
I wrote an article about 6 weeks ago, which I went into greater detail in relation to what our forecasts in relation to interest rates are and what impact it will have to house prices. Now, Peter Tulip and Trent Saunders have done a really great paper in 2019.
And they're RBA economists.
The RBA economists, which talks about the relationship of interest rates versus the difference in the interest rate versus property prices. The most interesting part of it is that if you have a 1% decrease in interest rates, it approximately impacts by appreciation of property price about 30%. So let's look at the reverse. So now we're going to be looking at the interest rates going up. Will it have the same impact? Now, our belief is that you have to look at some other variables, which are also commented in this paper as well. We do have a shortage of property. We have immigration kicking in, which we haven't had for the last 2 years. And there are other variables as well, such as vacancy rates, which are now lower than they were pre-COVID.
Yeah, and rents are taking up.
And rents are going up.
Yeah.
So if you take all those into effect, I think the negative impact in relation to interest rates won't have the same mathematical impact to property prices. So we have a conservative view, around 15%. But more importantly, even though that our view is conservative in relation to where we think property prices, investors into our fund are not impacted. So let's say that I'm wrong, because really a forecast is a forecast. And they increase interest rates, call it 2.5% because inflation gets out of control, and property prices fall by 30%. Now the deals that we have done in our fund, and being an ex-banker myself, I look at worst case scenario. I wake up in the morning thinking, even though I'm confident in my forecast, what will happen if I'm wrong? So therefore, what we have done, normally we lend, and I'll try to explain this a bit more, we lend 75% against any particular asset that someone offers to us.
As collateral in case something goes wrong.
We are secured lenders. So once again, it's a control measure. So if a borrower borrows from us and they can't pay it back, what's our recourse? What's our security? So if in the current market, are we doing 75% geared transactions and offering it to our investors? The answer is no. We've actually pulled it back to around 60, 65 in case if we do
so
have a...
price will have to fall more than 35% before
right.
you might have to go and sell someone's property to get that money. Yeah.
And the reason why we need to do that is that people rely upon our asset class for consistent, regular income. Now, if they don't get consistent, regular income with asset preservation, then that is the whole reason why you invest with us, and people invest in our asset class. And I think it's quite important to say, with all of the volatility that you have in the current market, people should be looking at that portfolio and saying, is my diversification there? Do I have enough income in my portfolio to withstand an economic shock? Now, it's more probable now that we might have something, we don't know the timing of it, but it is probable that it could be this year, could be next year, or could be the following year. So it's about that revaluation from a risk perspective for investors all the time to see what they're invested in and how it works.
And I guess the important link and why you would do this analysis is that if you believe the 3.6% cash rate was a possibility, you then, using the tulip numbers, have a very big fall in house prices. And sure, you would temper it with the other factors, but still, it would worry you a lot in terms of what might happen to your business and the value of the collateral that sits behind these loans that you've made out there. Where does your confidence come from that CBA and Matt Common is more right than the doomsday view?
I'll tell you where the confidence is. Because if you look at affordability, and
I think that was the question. I did want you to tell me that, but go on.
That's right. So if you look at affordability, I don't think the Reserve Bank has a lot of option in relation to increasing it beyond that particular point of time.
Yeah.
The negative Keynesian effect is that if you take out too much cash flow, after-tax cash flow, from households, then you'll have the reverse effect, which is we might be in the risk of a recession because businesses are not going to have as much turnover because people are withholding that money to pay their mortgage. Yeah. That extra spending is not going to be in the economy, and then we'll see a reversal of our great fortune of unemployment rate being under 4%. So I think it's a delicate balance, and I personally believe that even if there is pressure from inflation to increase interest rates, it will be done over a longer period of time, not necessarily in a 12-month period. Yeah. And I think the danger is for a lot of economists looking at the rest of the world and Australia is that we do have two very important aspects of my belief, is that they can cushion our downward risk in relation to needing to increase interest rates and inflation. One of them is that we got immigration. So Australia is very fortunate that we can increase immigration beyond 1.6. So before COVID, Australia net migration was second largest in the world. And that has a significant bearing in relation to as a hedge against certain inflation pressures. Second of all, we have an economy which is based on an inflation hedge, which is mining stocks. So I think those two elements puts us in a more favorable position in the midst of a particular sort of market event or over the next 2 or 3 years.
So I guess also what would help your scenario come true would be, China gets out of lockdown as soon as possible. And I read today, June 1, they're talking about going out of lockdown, which would be great because that improves the supply chain problems, hopefully reducing inflation over the next, say, 3 to 6 months. And then on the flip side, if we can get some kind of peace between Russia and Ukraine, that would be another positive to bring oil prices down and other commodity prices, which also would be a big help for inflation because it is the inflation fear that's driving these really big interest rate predictions.
Yeah, absolutely. Look, there is always, in any type of economy, there is always downward risk and upside risk as well. But I think the energy crisis playing out in Europe, I think, is overplayed in relation to inflation in Australia. So if petrol has gone up to $2 a litre, that's a one-off event. And yes, it will pass on to food and other items, but not necessarily it will be compounding. I think the other interesting aspect to inflation, and not a lot of people are talking about, is whether wages are anchored or future expectation of prices are anchored or not. And I think that we haven't had inflation since the 1970s. So the problem will be is that if you're an employee and you demand a 5% increase in your wages every single year, that will spiral inflation. But if it's anchored, I don't think there will be such a issue as what everyone believes it will be.
And why do you say if it's anchored? What's the basis of believing that it is more likely to be anchored?
Well, because it all comes down to immigration. So if you do, it's a natural hedge. So if you bring in more able people who can actually do the work, then you're not going to be demanding the one-off increases that we have right now.
So the baristas on $95 an hour out of the
right.
coronavirus will go back to $55 an hour.
I was listening to, the certain professions are making more money than, anyway.
Not you, but
yes.
other
yes.
people.
That's right. But there are anomalies in the market at the moment which don't make any sense, and I think those, once they come out, we should get some balance there as well.
Okay. One last thing, as an idea of fear or confidence in the market, are you seeing lots of people prepared to go into alternative lending products like yours?
Absolutely. Yeah. Look, the demand of what we do is increasing, is because I'm an ex-banker myself, and I know internally from a bank, as soon as you see the property prices are decreasing, they also change their credit policy. So we're getting some fantastic opportunities, which are bank-grade clients coming to us, because we can understand the business, we can do it quickly, and it's not that much more expensive than what the bank is offering.
Okay, and is that therefore a reasonable indicator that there's still demand out there for money for business expansion purposes? Because most of your money goes, it's not for residential, it's for business expansion.
Absolutely.
It might be backed by a residential property because it's the collateral. But so you're an indicator of demand for money for business expansion. And at the moment, you're not seeing any.
We're not seeing any contraction.
Or anything like that.
We're seeing very healthy, and the proposals that are coming to us are A-grade quality. So from that perspective, we don't see any issues there from the structural issue in relation to the economy.
And Paul, what about that same question from an investor perspective?
Look, investors, our current investors, enjoy the ability to choose the investment that they want, a specific loan that they want to invest in, which is a great benefit over some of our peers at the moment, because not everyone's risk profile is exactly the same. But for an example, we're offering 7% net return to investors that is paid monthly, and it's secured against A-grade quality, and the gearing of it is no more than 65%. So it is very attractive from an investor's perspective. Also, we've got 39 loans that are under management at the moment, and we have 0 arrears as well. So that actually shows the quality of what we're actually doing as well. Yeah, okay. Well, that's a good piece of news about the market. Great stuff. Thanks for joining us. That's Paul Miron from M Square Capital.